Hello traders, this is Fawad Razakzada, market analyst for City Index. Today is the 18th of February. So let's have a quick look at the markets then, and starting with the euro dollar. As you can see, rates have stalled around the 105 handle following last week's rally. But here it's testing key support between 104.30 to 104.42ish, the shaded blue area as I zoom in. As you can see, this area was previously resistance. We broke above it last week, and now we are testing this area as potential support. With the US investors coming back after a long weekend, we could see a potential recovery from here following last week's price action when the US dollar failed to react positively to inflation data from the US, which came in hotter than expected. Of course, retail sales disappointed on Friday, as you may remember, but that didn't cause too much volatility. But the focus remains on a potential resolution in the Ukraine war, and that is what is helping to drive FX volatility, keeping the US dollar largely undermined. But let's see if it will hold here, and if it does, where do we go from there? So the key level to watch on the upside, and so far as the short term is concerned, is at 104.67, marking yesterday's low. If we were to move above that level now, that could put the bears in a spot of bother, which could then potentially see rates squeeze higher towards 105, possibly break that area later in the session or later in the week. And if we go above 105 on a daily closing basis, then that could pave the way for a potential continuation towards 106, possibly even 107 in the coming days. On the downside, if support around this area breaks down, then we could see a potential drop to 103.50 area initially, possibly down to 103 thereafter. But the path of least resistance following last week's price action is to the upside. Overnight, we heard from the Reserve Bank of Australia, who cut interest rates as expected by 25 basis points. But the press conference was quite hawkish, where the central bank governor highlighted the risks to inflation, and that has kept the downside limited for the Aussie dollar. The Aussie dollar actually has been showing bullish price action in the last few weeks, ever since it formed this hammer candle around the 61.30 area a couple of weeks ago. It has been printing bullish price action, and so far it looks like the bulls remain in charge, particularly with the previous resistance breaking at around 63.30 area, the shaded region here. So this area is now being tested from above, and so far, as you can see by the wick of this candle, it is holding firm. So for as long as this area now remains supported, the path of least resistance will be to the upside, potentially paving the way for a run towards 65 handle in the next few days. On the downside, the 21-day exponential moving average comes in at 62.80-ish. Below that, we have 62.70. That area then is the next downside target in the event of a breakdown. But given the bullish structure, the path of least resistance is to the upside for now. Now, the US markets have reopened following Monday's holiday, and after hitting a new record high above January's all-time high, the S&P 500 has now turned negative on the session. Let's see how it will close here, because obviously Monday was a bank holiday in the US and the cash market was closed. So you could potentially disregard Monday's price action. So far, the bullish trend remains intact. I mean, we are holding above the key moving averages, the higher highs, the bullish trend lines, and everything else. So on that front, the trend is continuing to remain to the upside. But on the other, momentum indicators are flagging a little bit, and the major indices have reached extreme overbought levels on multiple time frames, which argues the case for a possible correction of some sort in the coming days. But so far, we haven't seen a bearish price candle to suggest that the markets have topped out. So keep an eye on key support levels to see if the markets will remain supported moving forward. So the key level to watch on the S&P 500 now comes in between 6,075 to 6,100, which is basically the area between these two candles. This area was previously resistance back in December. We tried to break above it on a few occasions until finally on Thursday of last week we closed above it. So the area between the high of Wednesday's candle and that of the December peak, the shaded blue region, is the most important support zone to watch in the short-term outlook. For as long as we hold above that area, even if we see a little bit more of a pullback, I think the bulls will remain happy. But should we go below that area on a daily closing basis, then that could potentially signal the start of at least a short-term pullback towards some of the longer-term support levels. We'll cross that bridge if and when we get there. For now, these are the key levels to watch on the S&P 500. For more market insights and analysis, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.